Hello, welcome everyone, good morning. I'm supposed to moderate this session with two other gentlemen, and they say my questions are difficult as a moderator, but not in a way that you will want to escape from. But so this suddenly turned into a fireside chat with beloved Juliet, and so that's what we're going to discuss, I guess, like in a more detailed way. And Juliet, maybe would you like to introduce yourself and the new tribe's formation?
Oh, sure, absolutely. So first of all, thanks for everyone to come here that early the second day. So we are kind of survivors who just made it early in the morning for this panel. I really appreciate that. Briefly about myself, my name is Juliet. I'm a fund partner at New Tribe Capital. We are one of the earliest VCs who were started in Dubai 5 years back when there was no Web3 in Dubai. And people were quite skeptical about the UAE ecosystem in general. But luckily, I witnessed how things have been evolving within the UAE market. And I believe nowadays it's one of the biggest Web3 hub globally, and everyone wants to get up there. So we advise government, we do events, so we try to be very active ecosystem players in the specific market.
That's exciting. So the whole Web3 game and Web3 investment is changing. 5 years back, maybe VCs were not that relevant, and I call it the Web3's unloved child, like that goes to a Ivy League school, and you just like have that like internal conflict with it all the time, but you cannot live without it, and it brings so much fresh capital. And how do you consider the change of this capital allocation within the years of your activity in Web3?
5 years back, actually, we were at the very beginning of like a bull cycle, right? So we were right in time, and that time everyone treated VC more from the very speculative.
Welcome,
we have
gentlemen.
Vineet, more people to join our panel, so.
That's right about the time, honestly.
So you need to take a mic first.
Sorry, guys.
I keep up going about the market change. So the question was about the market change, and I'll start first. Then you can introduce yourself, and then just jump in, telling how the market has changed within the last 5 years. So I believe 5 years back, lots of people treat VC as someone who can support you to get listed on the exchange, to bring the community, to introduce you to other VCs, et cetera, et cetera, et cetera. That right now, I believe the market has experienced a dramatic institutional shift, as we can see. I sometimes call it like a fintech renaissance, and it's not given that much space for the speculative element within the token. So that's why if you're the VC in the space, you need to be very sophisticated to some extent, and you need to understand what you want to support, where you would love to place your capital at, and what is your overall long-term strategy.
I guess we can get back to the, the first question.
Now they're with mics,
so
yeah,
go
ahead.
You can just
First of all, guys, sorry for the delay. I thought we weren't sure what time the panel is starting, so sorry for that. Hi, I'm Vineet. I run Sigma Capital. Sigma Capital is a fund based out of Middle East. I've been, people know me with other funds. I've done 2 funds before this, and great to be here. So that's an introduction and answering to what Juliet was saying. Again, this industry is changing. 4 years back, people were randomly investing in something without even understanding what these tokens are. There was no, people were raising money to plant trees in Africa and doing $1 billion valuations. But I think 2020, we saw use cases come in. Today, we understand that Aave is one of the top 50 banks in the world. We understand that WorldCoin is trying to digitize your identity, prove that it's a human on the other side of the computer. But I think the next cycles are going to be about adoption. How can you get real people on board, real numbers behind it, and how can you get real money? Because crypto bro money is still small. Real money lies in traditional finance. how do you bridge that? How do you get $100 million out of that big family office? So going into the future, it's much more different. I think VCs definitely have to find great deals, but also become a bridge between real world capital, real world adoption, and real world developer activity. So hopefully we do that in the future.
Thank you, Vineet.
Cool. Sorry for being late. Same as him. We were actually just standing over there. Didn't realize what time this started. I'm Naman. I'm the head of research and investment partner at Big Brain based in New York. We are a prop cap fund, mostly known for our Solana investment. So I guess that's my intro. I guess I would take a little bit of a different take than the two other folks here, which is I think the market has changed, but crypto's foundation is still philosophical. And yes, we need to get real world adoption, bring in family offices, and that's where we see DeFi kind of shining. I think the fact that there's intangible value, we've already seen that occur the last year with all these meme coins. The thing is like, even Web 2 is moving towards attention markets where attention is value. You see TikTok famous founders raising 15 million from A16Z because you can essentially directly monetize your attention and turn it into revenue. And I think meme coins is another good example of this, where it's rather than having someone famous market and then get recurring revenue, you directly monetize attention itself. And distribution is becoming more and more important. So what I'd like to see and find out is how that shifts across the next couple of years, as even Web 2 tends to see value come from intangible, more distribution-focused revenue streams. And then in terms of how things have changed, I just think there's just a lot more projects to look at. And because there's a lot more projects, there's a lot more noise. And generally speaking, noise is hard to filter through, and that's probably the biggest change I'd say has happened in the last 5 years.
Thank you. We started with the ways it changes the capital allocations within years. And obviously the Web 2 to Web 3 transition in terms of what to invest and how to manage those investments are different. And how do you see the maturity of Web 3 at this point? Because like a lot of initial VC behavior change, and there was an interaction rather than like applying all the Web 2 due diligence and the ways we elaborate the projects, applying that same attitude to Web 3. Like we had to evolve, and the last couple of years were like eventful actually in crypto as well. How do you elaborate, and how do you see your own evolution actually as an investor in Web3 with your like past habits and also related to the future of the space?
Okay, so as I say, there is no Web3 as a separate industry, because before we always used to stay aside. There was like the whole space, traditional space, and Web3 space, which is something like that stays aside. Now everyone is talking about innovation in general, and innovation is of course like it's driven by AI technology, but blockchain technology, and maybe some impact investment, and something new that appeared within the last few years, and where someone like would love to place their money in. And in terms, same like, when we are talking about Web3 VCs, there is no Web3 VC as such. And as a VC, you should look at the broader picture where you understand that there is a practical use case and there is a Web3 technology that helps this practical use case to evolve. And like to elaborate on what Vineet just said, and it's really important not to only build the technical infrastructure, it's very important to build the use cases for the technology and to expand it to the certain applications, to probably some certain framework for enterprises. That's why we see like, the stablecoin summer, because of course the Web3 technology is going beyond the border, and now it's a kind of the fifth industrial revolution that people have been talking about for a long time happening, and it's driven by digital payments, because people realize that the world becoming more global. Globalization is here, and people don't want it to get stick to a certain place. They want to proceed that transaction without any border, instantly, with a minimum commission. It's just an example. And as a VC, you need to understand where the market is going and not, it's really hard to keep the speculative element that you feel like, okay, I place my money here, and just because I can just double down on that technology and get some good revenue within the year, you need to understand how you could support that technology, how you can help, and that's why like lots of VCs are becoming like an ecosystem players, where you have community, where you have partners, where you support government, and that's how the market goes.
So when it comes for my understanding, for me, Web2, I consider more of an equity-driven market where it's all about ownership of revenue. You have a company, you sell your equity, do Series A, Series B, suddenly you have $100 million of revenue, you do a listing, and revenue comes to a shareholder in the form of dividends. This is for me what I consider Web2, other than the technical definitions that are there. But in Web3, I think it's more of a token-driven economy, which means ownership of process. Token usually should not represent revenue, should represent process ownership. And I think the best example someone has developed recently is that, if you are Manchester United as a team, the revenue of Manchester United goes to the owner. But Ronaldo, who's playing for that team, is basically a token. If he scores goal, he was bought for $10 million, he becomes worth $100 million. People who invested in Ronaldo make money. So it's a process-driven thing. The only thing that I see when people shift from Web2 to Web3 is that there is no tagging of process to the token. So, for example, Binance, when you're working on an exchange, the revenue goes to CZ, but the trading fees is basically done on tokens. So when Binance starts doing $100 billion, the revenue from it definitely goes to CZ, but because the token is required more, the price goes up in a very simple way as such. But when I ask a founder that, okay, you are launching a token, how does this token control your process? There's no answers. It's a governance token. So what do I do with governance? So, for me, I think evolution, whenever I meet Web2 founders, they come with the concepts of Web2 and try to implement it in Web3, and they sometimes fail. You have to be degen enough. You have to have that process, because, they even don't understand why a token will be held by a founder. So they say, I'm launching a token, it will go up in price because people will stake it. That's not a use case. So thing is, evolution will come when people get more clearer on how tokens are and how they have to run.
And all the fundraising methods, actually, it's evolved as well. Maybe we can get back to that as well. Like now it's more hybrid model, equity token and everything, which sometimes dilutes the actual economic model just because it's hybrid. But maybe Nama also would want to contribute.
I think you're right. It's an investment in the process, but it's also becoming more and more of an investment in the equity itself. Believe, Launchcoin, good examples of where you have Web2 companies that generate revenue that need to drive kind of a more cult-like attention market to their platform, and they do that using crypto to bootstrap their community. And you see all the deep-in projects where revenue is going into buybacks, which is going to the token holders. Really, I think there's two values to a token, as you said. One is the process, but the other one is US markets have made it impossibly hard to go IPO. So a lot of companies are going the alternative route, which is, I can launch a token, and even if it is just for a regular business, as long as value goes back to the token and the US government doesn't consider it a security, I can launch as an equity. And having equities on public markets generally means that you're going to see multiples, which lead to more cash for the company, which then creates a flywheel allowing them to develop a product that is better. At the end of the day, you still need to build the real product, and I think a lot of crypto falls apart when it comes to that, which is half the time they'll raise a bunch of capital, they'll get a bunch of capital from the public markets and then not deliver a product at all, which I think is where we need to see a shift / some sort of innovation that allows people to delegate money correctly.
Yeah, this is a really important point, because if we merge the both topic, actually, when you're launching anything in crypto, basically, yes, it is essentially a fundraising tool, but you're also building an economic model for a community. And if you're not going to make sure every token holders eventually gets something out of it, like in terms of like being part of something and be like financially being rewarded, and also like maybe some sort of a governance, maybe you don't need to do it with a token. And the whole thing before the fundraising and when we do the consultancy for the pitch deck and business model optimization, I always say like pitch deck is basically for yourself first, like to begin with, to actually know every part of your business and how the economic model is going to unfold for the investors, for the token holders, for the, even if it's vested, like are they going to have any motivation to still like care about it in 2 years, for instance, even if it's vested. So it's basically the whole dynamic you have to imagine. And maybe if you don't, if that doesn't excite you as a challenge, maybe you should do it like in a like more traditional way. So the fundraising methodology always is also really important. Are you doing something like for community? Or you're going to raise from a couple of VCs and your friends and LPs and everything, and then you're going to be able to do the same thing, then maybe don't do something like super community-oriented or call it a Web3 project. Like you can use it as a, like some add-on, right? And how do you see the fundraising methods and the relevance of the fundraising with the product and the project?
So I'll start from tokenomics first. Like when people fundraise, I always ask the question, why do you need to fundraise? And that's what projects need to understand first. If there is like a necessity to fundraise right now, or they're able to deliver some proof of concept without extra money first, and then just go and fundraise, where people can see that the product that they're building makes real sense. And talking about tokenomics, there are two things. First thing is that, as was mentioned, like you need to deliver the proper utility. Of course, if you're like launching the utility tokens, because staking and governance, it's not enough, because you need to engage the community and people who would consider that by owning the token itself, I'm getting some specific value out of that. But the problem now is that lots of projects equity is performing quite well, and then the token is are not performing at all. And the reason for that, as I mentioned, like when we have the institutional shift, and then like some projects they're mainly focused on B2B sector, and if they're focused on the B2B sector, then they don't need the token at all. Because in most cases, you'd rather integrate some stablecoin payment, and then you just serve your clients with a product that you've just built. And there is no need to engage community as such, because you're working with the enterprises, you're working with institutions, you're working with B2B. There is no B2B2C element where the community can understand that they are gaining some value out of the token itself. And then again, for tokenomics, it changes. It changes because lots of traditional players are coming into the space. And some tokenomics, like a few weeks back, I seen a very big project tokenomic, and I told them, like, guys, looking at your tokenomics, like you are getting like a 60% of the whole supply right before the investors, and what are you going to do with this money? Because you're targeting like X5 from the current valuation. So it's a big amount of money. How are you going to spend it, and why you're building this such tokenomics? Because nowadays, I believe it should be matched with the proper financial projection, where you're able to explain your investors that you are generating this revenue within this period of time, and that's why with the market expand, you need to spend more on a regular basis. And that's why like fundraising right now, it's becoming, I believe, more focused on the strategic deals, where like both parties, investors and projects, they understand that this specific collaboration will help them to move forward and to grow the ecosystem that they have.
So when it comes to funding, I have two different thought processes. One is, as a founder, I always believe, I did startups for 15 years. I used to make startups run through revenue and not through funding. I think if you know what you're doing, just get revenue and get going. Put your own money,
Yeah.
and maybe raise someday. But something that happened in this meantime was, I was doing $500,000 revenue in my startup, last startup, but COVID came. Suddenly revenue dropped and there was no capital in the bank account and the company had to shut down. So capital has to be raised for two things, one for growth and one for safety. So when do you need to raise? When the markets are right. Suddenly everyone's talking crypto all around the world. Everyone's talking crypto in the US. This is the right time to be investing. But maybe the scenario doesn't exist in the next 1.5 years.
Exactly.
So what I would say is fundraising is all about what do you need the money to scale. Today you are selling 100 pieces. How do you go to 1,000 pieces? But also how do you last doing that for the next 3-4 years? Because in 3-4 years, when you are selling 1,000 set of pieces, definitely you can raise more capital because you have revenue to back it up. Secondly, tokens become interesting because, in Web 2, we used to say that customers are your biggest investors. And technically, tokens can be used as a way to get customers on board who hold to your tokens because they believe in your vision. Again, a lot of liquidity players have done that in the past, but again, the incentive alignment has to be thought about. So it's a lot more research. If anyone's raising right now, I think the best time to raise and best time to keep building.
I would say fundraising landscapes have changed quite a lot. AI throws a pretty big wrinkle into how we think about things and how things should be structured. The cost of development has gone down significantly. The speed of development has gone up significantly. And I think we're seeing companies go from 0 to 5, 10 million in ARR in the matter of 6 to 8 months, which was unthinkable, 5 years ago. So then the question becomes do these companies maintain, is it actual ARR or is it going to be kind of these quick, continuously changing markets like we've seen in crypto before, where it's a company captures attention, captures distribution, captures revenue for a year, 2 years, and then 2 years later, some other company comes in and takes that from them. In Web 2, I guess good examples is Cursor, Windsurf, Codex. You've seen all of these coding competitors come out, and as the market gets more and more fragmented, really revenue numbers keep going up because the market is so big, but over time, these companies don't really have a fully blown moat. And as we see IDEs disappear, some of these companies probably lose their moat entirely, which is Cursor's integrated with that ID, and a lot of developers use it for that purpose. I think in Web 3, we see the same thing where it's applications don't require nearly as much capital as they did 4 years ago. And if they don't require that much capital, then what kind of what do you fundraise for? And you fundraise for what he said, which is growth, and I would say almost also branding, right? Because as branding becomes more and more of a moat for your customers, VCs are kind of playing this part that gives legitimacy to a project. And then infrastructure heavy, things that require years of work, obviously those still require venture money because you need that safety, you need that runway in order to be able to build something complex. But a good example of this last cycle, Pump.Fund is a great application, has made a lot of revenue. Did they really need a bunch of venture money? No, they didn't. They took a very, very small round and then just kind of ran with it. So I kind of see that kind of expanding going forwards as AI takes more and more of the development stack and makes things easier and easier to do.
Actually, let's also not forget how everything started, right? Normally, when you have a technical solution for a product that has never been made before, that was not possible before your imagination and your mathematical solution, and you basically come up with that product on paper, with the white paper, then you just need to fundraise to build it. And that was how, but right now the products, to build it as such, it's not innovation, it's not nothing, there are so few projects that actually just have the solution, but they need the money just to build it practically, and basically you have the formula and you fundraise among those who actually believe in that application and that there's going to be a future for that infrastructure. This whole thing has changed. So not right now, if you have more or less tokenization model and everything, you just need conviction to actually get people on board, and that's why you raise. Or from the technological innovation layer, it is turning into a more business setup sort of a way, and that kind of like mixes and probably bringing more VC relevance. And how do you maybe see the product, technology, and the founders and the market trilogy basically in terms of your decision to invest in something? The technology, like are there any technological spaces that you like, okay, this rings a bell and I would just be in, or like you still are more like, okay, let's see the founder and let's see the execution and let's see the market readiness? Like, how do you balance these three?
Okay. So there are a few elements where we still see the future of technology. First of all, like practical applications and use cases within the Web3 space. The same old school, like a really good infrastructure that could be scalable so far. This is number one. And then let's talk about RWA and tokenization, because as we see with the regulatory space got lifted recently, and especially where we are, like UAE market, and everyone is talking about tokenization. And it's interesting, lots of big businesses, they just want to have the democratized access to community, to the global community. And it comes not to the point that you can tokenize businesses. Like, for example, last week I got a meeting with MasterCard, and it's interesting, they told me that they have a product that's called multi-token network, which is launched actually. It's basically you can collateralize your deposit and use it to pay within different banks to different people and even to the crypto wallet. So basically, like, you're using the technology, and it's built on private blockchain, of course, but you're using your deposit, and then you can just proceed any crypto transaction. The money are getting deducted from your bank account automatically by the time you're making any transaction. This is the real mass adoption, right? Like the problem for that I see, because we are launching some big initiative in the UAE as well and within this space, is that like most of the people are still building on the private blockchain. And then of course for the security, for transparency reason, but of course to the certain extent there will be like the toolkit, the middleware solution, which helps them to build publicly and engage more people from the Web3 space as well. So it's a perfect merge of Web2 and Web3 ecosystem, and I believe that is that Web 2.5 that we've been talking about for the last, like, I don't know, 3-4 years, that's happening right now, and the real mass adoption of the technology that nobody can deny any longer.
So Melissa, before I answer which segments, you mentioned that fundraising was done to build product. I fully don't subscribe to that parameter because, yes, you require money to build a product, but if you see recently, money is raised to change behaviors. I'll explain what it means. Uber didn't raise billions to build an app. They raised billions to make you lazy not to stand out in the sun. Please understand, in India, when e-commerce came up, no one would, if you're buying your shirt, you would go to a shop to buy that shirt. Because you would be like, will it fit me? How will I look? They changed the concept in people that you can order home and it will fit, and if it doesn't, you can return it. So money, in Amazon's case, Amazon was negative for 8-9 years and he continuously raised money to build warehouses across the US. This is Jeff Bezos. He was not marketing it up. He was building warehousing so that when you order something today, it reaches you by tomorrow. So they're changing the money is being raised.
Technology changes behavior.
Behavior change. So technically, that's where the big money comes in. Now in Web3, have we seen people changing behavior? I think I saw a small case in Bermuda. I was at Bermuda conference, digital conference recently. In that whole place, Circle made this place where, the local people could come and sell stuff. And Circle gave 100 USDC to everyone to spend it up. So you could not give cash there. You could only take 100 USDC and give it to these people, which was airdropped to you. So now they got these 50 people addicted to the fact that you don't need money and you can use USDT to buy and sell stuff. Only thing is, it's a longer process. I haven't seen a lot of companies. Has Aave gone to Africa and gotten people interested in using Aave as a way to generate a 5% yield? No. USDT has grown organically, yes. So I think a lot of that has to come in. Money has to be raised to get adoption on board. And now when it comes to segments specifically, I think anything that can get people on board, we have had enough layer ones, 100 million transactions per second, great. But now let's have those products which will get those 100 million transactions. So real world assets, gaming, identity, a lot of these things are focus areas where founders have a plan on how they will land up in building a great company. That's what we are investing.
I agree with him. When you talk about money, you're not raising for the product. At this point, building a product is pretty easy unless you're talking about something that's deep tech, which is, I wouldn't consider crypto deep tech, right? Now, when it comes to markets, I think as a VC, you kind of ask between the founder market and project kind of trilogy. Like you're as a VC, you're betting on a founder. At the end of the day, for us, I think the majority of it is you're working with a person, and that's who we're investing in. And then I guess to kind of build off of his point, there's a couple things, right? Like for us, we're looking into AI and robotics. Why? Because crypto brings a unique perspective and unique ability to onboard a lot of data that doesn't exist in Web 2. You have things like Scale and you have things like Snorkel that'll pay people in the Philippines to label, trillions and trillions of data points. But you also just have tokens that can do that for you, bootstrap the cost of doing that by rewarding someone with some sort of intangible token that doesn't really have any cash value at the moment. And there's a lot of robotics companies in China that are coming out and kind of doing this model. You could say Tesla with robotaxis is almost a deep-in company if they are able to execute and allow cars to kind of be self-driving across the US. I think, as you said, at the end of the day, we want to bring people on board, and bringing people on board comes from two things. One is probably stablecoins, and two is new technologies. But the thing is with stablecoins, I think with the passing of the Genius Act in the US, there's a lot of risks associated with the current state of stablecoins that we have today. Just because if the US government and banks start pushing stables and are able to kind of distribute across the world, I just think businesses like Circle, who already don't make any money, are going to fail, right? Like when you look at Circle's revenue, when 50% of it goes to Coinbase and another 30% of it goes to Chase, where do they really make money? It's not like minting a stable coin is a money-making process. USDT is a little bit different, but I think for USDT to compete with all of the giants in the US that already have distribution, the second JP Morgan says, oh, your bank account is all stable coins, what do you do as a company in crypto?
Yeah, these are, we have 2 minutes, and I think this is the time where we can formulate, because we talked about the VC playbook of the next cycle, let's say. So we can talk a little bit about the, what will you be looking, a little bit like a formula for yourself. What's going to excite you in the next cycle? What's based on maybe your best investments the last 2 years, what kind of founder behavior, pitch deck, or any economic model beyond the product specifics, what would excite you, and what would you be looking the next cycle?
So first of all, dedicated founders who are here to change the world with the technology that they are building. So there should be some sparkle in the eye, and you need to understand that this person is here for a long time.
Because you are going to run out of money at one point.
Yeah, it's I've seen, there are a few examples, one, for example, virtuals, right? It's now virtuals, we invested in virtuals and everyone knows virtuals, but not that many people know that back to the days it was the company called PuffDAO with completely another narratives, right? This is the perfect example. It doesn't matter what you build. If you're able to adjust to the market and you're here to struggle through the long time, you will change your product, you will change your name, you will do rebranding, but you will struggle to make it in the right time with the right product. And talking about narratives, of course, I just summarize things up because we don't have that much time left, is of course AI is here. And I believe we found a perfect match between AI and Web3, finally, luckily. So payment infrastructure, for sure. Deep in technology as a perfect example and the bridge to the real world. And what else we have? So that's basically the few directions we are looking into.
So again, what excites me, I already mentioned the segments we are looking earlier, but I'll just put it in a different way. Guys, how many founders in this room right now? Okay, we just have 3 founders. Any more founders? Anyone who is doing a startup? How many of you have a runway for the next 3 years? Out of these 3 runs. Runway for 3 years. That means you will survive for 3 years. Just one? Guys, please see to it that you have your runway in the next 6 months. Because markets go up and markets go down. There is great times to raise capital, but you always need to be able to survive for 3 years. You don't know where the markets are next year. So for me, what inspires me is these founders who actually are focusing on building runway as well as revenue. In the end, revenue is the only way to build runway, and all those companies will excite me which have revenue and runway for years.
I've never seen so little amount of founders in a VC panel audience, but yeah, it's interesting, I guess. Good for you.
It's too early in the morning. Founders have been working
maybe that's why. But that's the dedication Juliet was talking about, right?
I guess for me, there's two areas of interest. I think AI and robotics is probably as she said, from a narrative perspective, the most interesting. And then stablecoins and revenue generating businesses in crypto are the other side of this, where I'd like to see founders kind of breaking into Web2 markets. CoinFlow is a good example of this. Just companies that can actually get Web2 customers on board. But I think it requires a different type of founder. We've seen a lot of founders in crypto that think the token is the product and they're selling said token. And most founders in crypto also don't understand what customer acquisition costs should be. I think airdrops are customer acquisition costs, and it'd be nice to see founders kind of take that into account, start focusing on using that capital to get real customers on board rather than farmers and users that are there for a short period of time and then gone within months. So.
Okay, we have 1 minute. Maybe let's talk a little bit about jurisdiction. All these companies being formed in from Gibraltar to Panama and some regions of UAE. Do you have any specific concern about the jurisdiction and how the company is actually formed when you're or any preference or any risk?
So I believe we have a few hubs right now. So of course, US market is still there with all the regulatory framework is being formed there. Of course, we have Singapore. Nothing much happening recently, the vice versa. Regulations tightening up in Singapore, and especially considering the recent regulation with regarding the WASP services. And of course, we are in the UAE. We are working with government, with regulators, and maybe people seeing the practical use case of tokenization. So WARA is aiming to be #1 regulator for tokenization. So together with Damak, which is the biggest real estate developers, they just launched the document called Title Deed, which is tokenized property certificate. And now they're aiming to scale that. And the other free zones, they're also doing some progress in terms of businesses tokenization. And of course, it's great for the government, then they can see the whole flow of businesses being based within their country. So yeah, in general, there are free hubs. I'm all in for the UAE market, but yeah, people can choose between the US market or Asian market or somewhere in the Middle East.
So when it comes to jurisdiction, I think 6 years back, everyone was in Singapore, then everyone came to Dubai, now everyone's going to US. My advice is when it comes to building up a structure, build at a place where jurisdictions are pro-crypto, a place like Dubai, Cayman, wherever you're. Everyone's now shifting back to the US because, 3 years back, US founders were saying we are not safe here, we need to go out. Maybe 3 years later when Trump changes, it is the same again. So I would say come to a jurisdiction which is more safer, something like a Dubai or one of those places, even Singapore for that matter. Yeah. But Singapore has now become a bit more restrictive. Yeah. But again, after you do that structuring part, it's all about where is your customer coming from. I think adoption layer for crypto will not come from the US. Giving 20% yield to an American is not sustainable. Getting 3% stable yield to a person in Turkey or Africa or Latin America is stable. So more than jurisdictions of setting up, jurisdictions where you need to build local relationships with the governments to roll out your product is important, and that is in Africa and that is in Latin America, not in the US for sure.
I agree and disagree. I think one of the big things with crypto is access to capital. I think a lot of the capital in crypto still exists in the US. The reason people are moving back to the US or incorporating there is really it becomes a legitimacy, and from the investor side, it's kind of a question of if we're investing in a company that's incorporated offshore in some sort of, in the Cayman Islands, for example, right? Can we hold the founder accountable, say they do things that are illegal? And generally speaking, that's not the case. It's kind of hard to do so. So I would say for a founder, yes, there's benefits to incorporating outside of the US, but from an investment perspective, you also have easier access to capital, US capital specifically, if you're incorporated within the US. And I think generally speaking, you had the whole foundation labs model that I think for now still works. I mean, I know people are kind of combining both and kind of separating. That model's changing a little bit as well. But I think there's value to both. And I think it depends on your customer, like your target customer. If your target customer is Asia or outside of the US, don't incorporate in the US. But if you want to raise US capital and you want to build something where your target customer is in the US, I'd say raise in the US. And he's right, 20% stable yields, they're not going to work in the US. Yeah. But some of these companies like Grass, for example, right, who's selling to OpenAI and Anthropic, for them having incorporated in the US is beneficial.
I'm actually happy to conclude with that message, like build real relationship beyond jurisdiction. Thank you so much.
Thank you.
Thank
New
you.
Tribe Capital, Big Brain, and Sigma, thank you so much. And if you have any questions later on, you can probably get them another 5 minutes here. Thank you.
Thank you, guys.
Thank you.
Thank you.